to our third quarterly call for 2015. We have muted all of the phone lines, and Peter O'Keefe and Justin Stevens have the microphone. This call is being recorded. Before we get started, we must remind you that the purpose of today's call is educational and that the material presented is publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. Furthermore, this presentation is not intended to provide any specific advice to an individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based upon your own individual situation. So, similar to last quarter's call, we want to make this call another avenue for your education. These calls are recorded for playback at a future date. Our reason for doing these calls is that we view them as lifeboat drills, meaning there will come a time when markets turn, and our objective is to have talked through the possible situations in advance of them occurring. The benefit for you is that you'll have heard this before, and you'll be more emotionally ready, and therefore our thought is you'll have more behavioral discipline. As we've routinely reminded you in our meetings, writings, etc., the number one factor that determines investor success, and in fact it's the dominant factor surpassing all other factors combined, is your behavior. Not your ability to time when to get in and out of the market, not your ability to select the best stock or country or sector to be invested in, and certainly not your ability to outperform an index. Your behavior dictates your outcomes. That's why we build a plan before we start investing, and we make sure that your behaviors stay in line with that plan. We're going to begin our discussion with a broad economic update about what is going on in the world around us today. There are a lot of headlines surrounding the international markets in the energy sector, and so we'll lean on the expert research analysts at JP Morgan again for some charts to assist with our talking points. For those of you who are just listening in, this shouldn't impede your ability to follow our comments. Next, we want to highlight some excerpts from a recent book that we read titled The Great Minds of Investing by William Green. Aside from being a physically beautiful book, the content is just magnificent here. We've compiled a full list of the pearls of wisdom that we're going to share in our next quarterly newsletter, but today we want to discuss two of the favorite quotes and give you some background on those individuals and explain what they're saying in their quotes. As we did last quarter, we're also going to spend some time highlighting a current investment. This quarter, we're going to talk about our position in General Motors. We'll review the fundamentals supporting the investment, discuss the opportunity ahead, and the potential catalyst that we see in owning the investment. We'll also talk about some other great minds that have taken a significant position in that company. Finally, we'll spend time answering the question that we received in advance of this call. This month we had just one question sent to us in advance, so pertaining to energy stocks. As a reminder, we welcome your questions in advance of the call. We want to spend time explaining our answers to any investment or financial planning questions that you have. With that, I'm going to turn it over to Peter.
Thanks, Justin. For our economic updates, we again utilize the research that is compiled by JP Morgan Asset Management's Guide to the Markets. For those of you viewing this presentation from your computer, you will have access to the visuals that we reference. First, we want to discuss oil. And the statements we've heard vary. However, the theme of the media seems to be that this time is different. And examples of the headlines include that crude oil is collapsing, the global glut drives crude oil below $50 a barrel, crude oil slides below $45 as oversupply fear persists. There's plenty of examples out there, and the questions have been rolling in from our clients. But why stay invested in oil companies, especially when many of the stocks have suffered losses due to their massive decline in the price per barrel of oil? Well, let me allow you to give you some perspective. To quote one of the greatest investors of all time, Sir John Templeton, the four most dangerous words of investing are, "This time is different." As the slide shows, we have been where we are today. In fact, we do not have to go back very far at all to retrieve some of the experience of the massive drop in oil prices. In June of 2008, the price per barrel of crude oil was $140. Just 6 months later, it dropped to $39 per barrel in December of 2008. That swing was much more dramatic than the one we just experienced. In June of 2014, a barrel of oil was $113, and it dropped over 7 months later to $48 per barrel in January. Today, there's been some minor recovery in the price, yet we're still near the recent low of about $53. History repeats itself many times over when it comes to the commodity cycle. And why does this happen? Well, let me remind you some of the principles of economics. Supply varies directly with price. Demand varies inversely to price. Because of the prevailing price of oil has been weak, we can assure you that the price of oil must be setting itself up for the next major advance. To quote a recent article in the Wall Street Journal by Nicole Friedman, which was published on July 14th, when you start cutting exploration budgets and you stop delivering the next frontier, the seeds have been sown for the next bull market. The price of a commodity does not stay consistent, and most of the financial media fails to grasp this concept. Instead, they project the current circumstances outward and create a doomsday scenario if everything stays the same. It'd be like me telling you if I leaving downtown Rochester and I'm heading north at 60 miles per hour, if I keep this pace and don't change direction, I'm certainly going to end up in Lake Ontario. The reality is this won't happen because I have the interest to continue to prosper as a human, and therefore I'm more likely to turn my car east or west, slow down or stop. The doomsday predictions have historically been wrong, and our thought is that you need to be careful and consider the facts before following the advice of such predictions. The reality is that the world is an incredibly dynamic environment, and the ebb and flow of prices changes in behaviors that ultimately causes the prices to change again. Our perspective is that the oil companies are trading at incredibly reasonable valuations. We want to own businesses that we feel will continue to compound at reasonable rates, and we want to own them at prices that are reasonable. So that's all I want to say about oil right now. Justin?
Thanks, Peter. Next, we want to spend a little bit of time talking about China. There's been a lot of speculation that growth in China is slowing down and that there is a bear market for Chinese stocks. The facts are there to support that Chinese stock prices took a hit in recent months. However, that's not where our focus lies. The chart I have on the screen shows the anticipated growth of the middle classes in the emerging economies of India, China, Brazil, Mexico, and Korea. The bars indicate the percent of the total population that was middle class in the year 1994, in 2013, and the future outlook for 2030. This is where our attention is focused. Notice China in particular. In 1994, they had virtually no middle class. In 2013, the middle class represented 18% of the total population, and in 2030, that number is expected to reach 72%. So do the math here. With a population of 1.3 billion people, that means approximately 700 million Chinese people are going to become middle-class citizens. So our eyes are set ahead on that opportunity, not the short-term turmoil that's going on in China. That's almost certain to continue for some time, and there's going to be short-term hiccups during this advance. As middle-class household numbers increase, our aim is to be owners of companies that supply both goods and services to the middle class. Our conversation will shift in a moment to exploring our investment in General Motors. Clearly, an automotive company is one example of a supplier of goods to middle-class people. As an investor, it is incredibly tough not to become absorbed in the short-term outlook. It's ubiquitous. The media's attention to details in the short term is higher today than it has ever been before, and the speed that we're receiving information is only increasing. Our advice is to turn down the volume on what's going on in the short term. Certainly, it's helpful to have a worldly perspective, and we want to make sure that you feel informed with what's going on in the world around you, but perhaps adjusting the filter to examine situations with a longer-term focus is a better way, a way that would produce less stress and anxiety and more optimism and confidence in humanity. So I'm sure somebody's out there laughing at that advice, and that's fine. It's one way to do things, certainly not the only way. But our thought is when it comes to investing in places like China and Europe and Brazil, is that the focus is ahead on the future. The uncertainty that exists in those places has created some terrific values in businesses, and that shows true potential for growth. I'm not predicting when those issues are going to be solved. It's just that they will be solved. So I think that's a good lead into our next section, Peter.
As Justin mentioned earlier in the call, we had the opportunity to become acquainted with 22 investors who are living legends by reading William Green's The Great Minds of Investing. The book was released in late May, and it provided us some fantastic quotes and stories behind people like Irving Kahn and Warren Buffett. Our plan is to include a full list of some of our favorite quotes in our next Value Connection newsletter in the fourth quarter. Today, I want to just review 2 quotes that apply to what we're talking about on our call. The first is from Pat Dorsey. Pat ran the equity research department at Morningstar from the year 2000 through 2011, and he oversaw more than 100 analysts. He's had a chance to be exposed to a lot of smart and a lot of not so smart investors. And the quote of Pat's is that we love is, "My goal is to find some of the world's best businesses that can compound at high rates over long periods of time, identifying them when they're trading at reasonable valuation and just marrying them." I don't think value investing could be summed up in a better way. Our style of investing is consistent with Pat's. We're looking for super strong companies that will be able to experience compounded growth at over 10% or more, and we want to buy them at a reasonable price. Let it be known that this strategy has its shortcomings. First, there's no guarantee that just because you bought something at a reasonable price means that it's the best price it's ever going to trade at. As value investors, we often encounter some problems of being underwater in the early onset of something we own. Second, the marriage of a growing business and increased stock price are not always tied together. In the long run, we feel confident they will be, but that doesn't mean the value is going to be realized by everyone in the short run. The virtue of patience is critically important to be a value investor. We're married to our investments because we've done our homework up front to identify some of the best businesses in the world that are compounding their growth and will continue to do so for a long period of time. Our focus as investors is to stay on those aspects of our investments and not on the short-term wavering of the economy or the market. The next quote is from Isabelle Levy, who runs an investment firm based in Paris that is her value asset management firm has handily beaten the benchmarks over the years. Isabelle has become successful by taking an approach of questioning everything. Her quote that we loved is from the book is, "When I see everyone doing the same things in the market, I usually go elsewhere." This is a theme that we often hear from value investors. Warren Buffett has famously quoted along the same lines that most people have heard. Be greedy. Fail to grasp the risk inherent in a business and subsequently overpay for that business, they often will lose money in the long run. I thought that sharing some of these quotes in our next newsletter will expose you to some of the other great minds that we've come across. The way that these people think and act is different. It's counterintuitive in many cases, but it's worked. And if we can incorporate these philosophies into your life, there's a much greater likelihood that you will experience success as an investor. Justin?
Thanks, Peter. The investment that we decided to discuss this quarter is General Motors. We've also decided to change our approach slightly from last quarter in how we review the investment to provide you with more insights to what we do when constructing our opinion of the company. As most of you know, General Motors designs, builds, and sells car, truck, and automobile parts worldwide. They also make a business in providing automotive financing through GM Financial. The company is incorporated in Delaware with their headquarters in Detroit, Michigan. GM is positioned as a leader in the highly competitive market, selling nearly 10 million vehicles in 2014 making them the world's second largest producer of cars and trucks. The company currently employs 216,000 people around the world, and it's currently valued based on the outstanding shares of stock at $50.4 billion. The current price of the stock is in between $30 and $31 per share. So let's start with what's wrong with this company. I think it's safe to say that most of us remember the debacle in 2009 that resulted in GM filing for bankruptcy. The stigma that event, coupled with a massive recall of ignitions in 2014, has scarred many investors. People simply have had enough of GM, and they feel that they were burned, and they'd rather just not own the business in their portfolios. We've had our fair share of concerns from clients when making the recommendation to purchase this company based on its recent history. However, that stigma surrounding GM has created a terrific buying opportunity, in our opinion. We often have to remind people that bankruptcy is the process of taking an unhealthy company, restructuring it, and the resulting company is a healthy company with good finances. GM is in strong financial shape coming out of their bankruptcy. In fact, they're currently sitting on about $20 billion of cash reserves, making the per share price of the stock even more attractive. The fundamentals of this company are also strong, in our opinion. They produced $156 billion of revenues in 2014 and $5 billion in profits. Currently, the stock trades at 11.7 times earnings and about 1.5 times the company's book value. The shares are currently trading in the low end of their 52-week range, making now a good purchasing opportunity. The income stream from the investment is also attractive. The company has not been shy about putting their $20 billion reserve to work in a number of shareholder-friendly ways. The current yield is 4.5%, and GM recently hiked their dividend from $1.20 to $1.44 in June of this year. That's a 20% increase in the income stream to shareholders. Additionally, GM has announced their plans to buy back $5 billion of the common stock. So we've talked before about hiring managers who act as stewards to your money. GM has been an incredibly shareholder-friendly company, and based on their current financial situation, we would anticipate this trend to continue. Some of the catalysts that we think will help move the stock forward in upcoming years lie in the emerging markets. We talked about the population explosion that is occurring in the middle classes of places like China and India. Many of the companies that we own stand to benefit from that growth. GM increased its China sales by 12% in 2014, making it one of their top markets. We would expect that both revenue and profitability would continue to grow in 2015 and beyond. And so actually, we'd suggest visiting the GM investor website and reading their 10K annual report, Section 1, if you'd like to learn more about GM's business. They're a leader in a growing market with a lot of opportunity to grow their sales and profitability in the future. We also feel confident going into this investment as we have had a number of well-known value investors enter alongside us. Peter and I subscribe to a research website called Guru Focus, which allows us to keep tabs on what major investors are buying. A few of the names found in the Great Minds of Investing book that Peter talked about are listed, including Arnold Vanderberg, Mario Gabelli, Marty Whitman, Joel Greenblatt, and Warren Buffett. Their write-ups all seem to be consistent with our analysis, and we find it to be a compelling story. With that review, that takes care of the business end of our call. Next, we want to move on to the question and answer portion of our call.
Thanks, Justin. Our first question comes from a client, Mike B. We continue to hold Chevron, Apache, and Devon energy stocks at your recommendation. Oil prices continue to fall. There's a current oversupply or glut of oil. Oil companies are laying off employees and have stopped investing in hydrofracking. Why continue to hold these stocks? Is it time to take our losses and move on? Great question, Mike. Thank you. I believe we touched a little bit earlier on this in the price of energy. During our comments, I referred to the Wall Street Journal article by Nicole Friedman entitled Seeding the Next Big Rally in Oil. And I suggest you read this article to get some good background on it. But I'll do my best to reiterate some of her points. Also noteworthy in the energy space is that on July 15th announcement that natural gas has surpassed coal as the United States' biggest energy source. The phenomena was literally unimaginable a few years ago. It is the reason that carbon emissions in this country have actually declined. So to answer your question, the commodity cycle has been a consistent theme over my investment career over the last 36 years. It's presently clear to invest in some of the world's best businesses that supply a product that we cannot live without. As I stated before, supply varies directly with price, and demand varies inversely with price. The fact that there is a prevailing weakness in the price of oil means that we're really setting ourselves up for the next advance. Our feeling is that the companies we mentioned in this business were bought at reasonable valuations and have very strong finances. They're currently selling at prices which is exactly the opposite time that we would want to sell them. We continue to believe it's a buying opportunity, and if you're currently owning these stocks, we would suggest holding them, and it's possible to add to them or reinvest in your dividend. We believe that makes sense too. This too shall pass, as we've seen this before, and I'm surely we'll see it again. The idea that an oversupply can only be a temporary issue is it's never a permanent one. Furthermore, you cited the term glut, which is fascinating because I've never heard this word come up in conversation, yet in the past months we've heard it on several occasions. The media certainly has grabbed a hold of the issue and again assures me that the issue cannot be possibly as serious as they're making it out to be. It is hard to step back and take an objective look at circumstances, especially when an investment performance is down. Our advice is to go back to the initial plan we embarked on, to buy only when prices are reasonable and sell when prices are unreasonable. The price of oil in general today is incredibly reasonable. And if you're able to, and it makes sense to add more, and you're able to do so, I would suggest that. If not, continue to hold on to what we own, especially considering the dividend yields from these three companies that we've mentioned. Some of you may well have read the news yesterday that Warren Buffett announced Berkshire Hathaway's biggest acquisition to date. They offered $37.2 billion to purchase Precision Castparts, a supplier of equipment to the aerospace and energy production. This is a company we've been buying in accounts since April, and we have built a decent position. Of course, we would have liked to own it for longer. However, it is motivating to see that Warren Buffett will pay a 21% premium to the current price of at a price of $235 per share. Buffett's comment on the subject were quite interesting. Warren explained, when you get a chance to buy a wonderful company, there's usually some reason why you are getting that chance, and perhaps a slump in oil and gas prices helped us in this case. Although it might not always seem clear, there will be an end to the short-term issues. And we trust that we are purchasing companies that are strong financially at reasonable prices with growth prospects. If we are properly diversified, it helps us to mitigate the risk of having your retirement greatly impacted on the results of a single position. Justin?
Thanks, Peter. This concludes the August 11th, 2015 O'Keefe & Stevens quarterly update call. This call is going to be archived in our library and can be requested by emailing any member of our team here at Sage Ruddy. Please look for the date and time of the next quarterly call in the fall edition of the Value Connection newsletter. We welcome your questions and comments in advance of the call so that we can prepare our responses. Thanks again for your time and have a great afternoon.